9 years. That's how long it has been since I started index investing via ETFs together with my wife. Our ETF portfolio has grown significantly since then, bringing our early retirement goal closer than we ever imagined when we started back in 2017. I have learned a lot throughout this period, which led me to change my approach more than once along the way. And just like everyone else, I've also made my fair share of painful mistakes. So let's get straight into the 8 most important lessons I've learned, with the honest hope that at least a few of them will help you save some time, money, or stress on your own investment journey. Starting with lesson number 1. Staying invested is harder than it looks. Picking a well-diversified low-cost ETF to invest in is simple. Setting up a brokerage account is easy as well. Even understanding historical long-term market returns is relatively straightforward. But actually staying invested and sticking to your strategy is far from easy whenever your portfolio is in the red and things start to feel uncomfortable. Here's what we've lived through since 2017. In 2018, we were down 14% at one point. The COVID crash saw us fall more than 30% before recovering. We corrected 16% in the 2022 bear market. Last year's tariff fears dragged us down 20% from the highs at one point. And more recently, our portfolio shortly dropped around 7% due to geopolitical tensions. And that's not all. There will be countless moments throughout your journey when other investments perform better, and you might start questioning if your money wouldn't be better allocated there instead. Whether that's gold, Bitcoin, sector ETFs, specific stocks, or something else entirely. We fell for the trap ourselves back in early 2019 when a close friend told us he had doubled his money within a year with automated forex trading. Without fully understanding what we were getting into, we blindly trusted his experience and invested some of our own money. After seeing incredible returns early on, we felt encouraged and added more, only to ultimately end up losing a grand total of 10,000 euros when things went south. That painful experience taught us to never blindly trust anyone's investment advice without fully understanding what we're getting into and the risks involved. One of the hardest parts of investing is simply staying put and sticking to your long-term strategy as you get bombarded with other opportunities over the years. And there's another important thing I've learned over the past 9 years. There will always be a reason not to invest. This is related to lesson 1, but it deserves its own chapter. There is no moment in time where the world looks perfectly calm and safe and it feels like a great time to invest. Since 2017, when we started, there was always something going on. In 2018, we had rising interest rates and trade war concerns. In 2019, the Brexit chaos, which dragged on all year, and recession fears. In 2020, pandemic lockdowns, which caused the history's fastest bear market before a massive stimulus-driven recovery. In 2021, rising inflation, supply chain chaos, and worries that the market ran too hot. In 2022, aggressive rate hikes due to high inflation, crushing not only stocks but also long-term bonds, plus the war in Ukraine. In 2023, we had a banking crisis and everyone was worried about the recession all year. In 2024, election uncertainty in the US and rate hikes in Japan, which led to fears around the yen carry trade. In 2025, tariff shocks in April, which crashed the market. And 2026 has certainly not looked any easier so far, with surging oil prices, which could reignite inflation and influence interest rates. Did you notice anything? Every year there was something else to worry about. Every moment in time feels special and different. If we had waited for the perfect time to invest, we would probably still be waiting today. I'm glad we didn't and stuck to our strategy throughout it all, as we would have missed out on average yearly returns of 11.62% over the past 9 years. The news will always give you a reason to hesitate. You will always find a reason not to invest if you're looking for it. The next thing I learned is that automation beats motivation. For most people, the motivation to invest tends to be highest when markets are up substantially. And it disappears exactly when you need it the most, when your portfolio is in the red and news headlines make you feel uncomfortable. The solution, for me, was to remove the decision entirely. My wife and I have a recurring investment that is executed automatically on the same day every month. No thinking required. It doesn't matter if the market is up, down, or moving sideways, our money gets invested. You can watch this video afterwards to learn how to set this up on Interactive Brokers. Because the problem with investing manually is that it's very easy to fall into the trap of waiting for a better moment when you feel that the market has run up a lot or when it's falling and you believe it's still going lower. Unfortunately, this approach tends to underperform long term, as you may end up missing the best days in the markets. There's a reason the saying exists: time in the market beats timing the market. My 9 years of experience as an investor so far have only made me believe this more. By the way, you can find my favorite low-cost brokers for ETFs in Europe linked down below, which is a great way to support me if you'd like to. The next lesson took me a while to learn. Complexity is the enemy of consistency. When I started in January 2017, I used a robo-advisor, which seemed like the easiest option since I knew almost nothing about ETFs yet. But after a couple of months of research, I realized I could just buy and hold ETFs myself and save myself the 0.8% of yearly management fees. So I ditched the robo-advisor and then immediately made the next classic beginner mistake. I overcomplicated everything. I split my money into 6 ETFs covering different regions, added a small cap tilt, and carefully allocated precise percentages. It felt smart and optimized, but in reality I was just creating friction. More trading fees, more rebalancing decisions, more tax considerations, and more chances to second guess myself every time I had money to invest. By late 2018, after simplifying twice, my wife and I settled on a single global ETF for all new investments, first in the distributing and then the accumulating version after learning more about tax optimization as well. We changed to another fund provider due to lower fees last year, but we're holding on to any existing older shares as they're nicely in profit and still in line with our long-term strategy. Selling them and having to fully tax gains already now, instead of later on in retirement when we actually need the money, doesn't make sense to us. Anyway, ever since simplifying our strategy to a single ETF in late 2018, investing has become almost effortless. Every month, we know exactly where the money is going. A single global ETF covering thousands of stocks from all across the world, both in developed and emerging markets. No need to rebalance, calculate precise percentages, or second guess our strategy and allocation. Simple portfolios tend to be easier to stick to over the long run. And the strategy you can actually stick to is worth far more than a perfectly optimized portfolio you can't stop second guessing. Lesson number 5 is just as important. Your savings rate matters more than your ETF choice. A lot of beginners spend way too much time comparing ETFs, obsessing over fee difference of just a few basis points, and checking which index performs slightly better in any given year. I'll admit, I did the same when I started. And of course, fees do matter, but once you're below, let's say 0.2% per year, whether your ETF of choice for a given strategy charges 0.07 or 0.15% in yearly fees is not going to radically change your outcome as an investor over decades. The single biggest driver for how far our portfolio has come since 2017 was our savings rate, meaning the difference between what my wife and I earned and what we spent, which we consistently set aside and invested every single month. Not our clever ETF selection, our timing, or other optimizations. Just consistently investing a large portion of our income month after month and letting the stock market do the rest for over 9 years. If you can find ways to increase how much you're able to invest each month, even slightly, for example by finding ways to earn more or by cutting unneeded expenses, that will do far more for your long-term financial goals than any ETF comparison ever could. Which brings me to lesson number 6. Dividends are mostly psychological. When I first started investing, I was drawn to the idea of dividend income. Because let's face it, seeing cash land in your account on a regular basis can feel very motivating and satisfying, especially as you see dividend payments grow over time as your portfolio grows. But here's what's crucial to understand. Dividends are not free money. When a company pays out a dividend, its share price drops by roughly the same amount. And when an ETF distributes dividends to you, the fund value also adjusts accordingly. You're essentially moving money from one pocket to another. And in most European countries, this means you now have to fully tax the dividend payment you received on your account. That is not the case with accumulating ETFs, which automatically reinvest dividends into more shares of the stocks they hold over time. This makes them a lot more tax efficient in most countries across Europe, as you're only taxed once you actually sell shares at a profit, allowing your investment to compound more efficiently. I'm of course generalizing here, and there are differences depending on where you're based. For example, in Austria, we still pay a bit of taxes even with accumulating ETFs on an annual basis. So check the rules wherever you live. Even still, these make investing even easier for us, which is why we've only been buying accumulating ETFs since 2021. And just to be clear, I'm not saying that distributing ETFs are bad. or that there's anything wrong with following an income-focused strategy. If that's the way you prefer to invest, as seeing regular dividend payments in your account keeps you motivated and helps you stick to your strategy, then you should absolutely keep it that way. I just wanted to give you the full picture, including the tax implications of either approach. Lesson number 7. Boring is good. 9 years is a long time to do essentially the same thing. Buying a global ETF every single month, no matter what is going on, and not touching it. And honestly, there have been plenty of moments along the way where that felt way harder than it looks. Because there was always something else that was performing even better in any given year than our boring passive ETF strategy. But that's when mistakes happen. When you're tempted to do something to feel more in control. So you start chasing something else that looks like a no-brainer at the time. And the worst part is, it never looks like a mistake in the moment. It feels like an obvious choice when your investment is not moving as much. Gold is clearly going up. That one sector is clearly the future. Everyone else seems to be making money except for you. That's usually when staying boring matters most. Because investors who chase whatever is moving tend to lock in worse returns. They buy high on excitement and sell low on disappointment. There's a reason why the vast majority of investors, including professional fund managers, underperform market indexes over the long run. As Warren Buffett put it, the stock market is a device for transferring money from the impatient to the patient. Boring is not a bug when you're investing passively into index funds via ETFs, it's the whole point. Lesson number 8. Your emergency fund protects your strategy. While this may sound obvious, I've seen far too many people underestimate how important having an emergency fund can be. The thing is, emergencies tend to arrive at the worst possible time, oftentimes exactly when markets are down. And if you're forced to sell ETF shares during a crash to cover unexpected expenses like a car breaking down or a job loss, you've just turned a temporary paper loss into a permanent real one. Your emergency fund isn't just about having cash that's instantly available. It's about making sure that nothing in your life forces you to make a bad investment decision at the wrong time. My wife and I keep around 6 months of living expenses in a high-yield savings account for that reason. Since I'm self-employed and we have a young daughter, we prefer a larger buffer than most. Depending on your situation and the safety net in your country, you might feel comfortable with less, or you might need more to feel more at ease. The exact amount is a personal decision, but in my opinion, everyone should have an emergency fund. Not just for actual financial emergencies, but simply for peace of mind. Because when markets are falling and the news get worse, knowing you have a solid cash buffer makes it significantly easier to leave your investments alone. Alright, let's wrap this up with a quick recap of the 8 most important lessons I've learned on my ETF investing journey since 2017. 1. Staying invested is far from easy. The psychological challenge is significantly harder than most people expect. 2. There will always be a reason not to invest. Don't wait for the calm, perfect moment. It will never come. 3. Automation beats motivation. Set up an automated recurring investment that is executed at regular intervals and remove yourself and your emotions from the equation. 4. Complexity is the enemy of consistency. For most people, simple portfolios and strategies are far easier to stick to. 5. Your savings rate matters far more than your ETF choice, so stop obsessing over every tiny difference in fees. Focus on what actually moves the needle, the amount you're able to set aside and invest on a regular basis. 6. Dividends are mostly psychological. What matters is the total return including taxes, not the cash flow in your brokerage account. 7. Boring is good. Patient investors tend to win in the long run. And lastly, number 8, your emergency fund protects your strategy. Without one, an unexpected moment in life could force you to make a bad investment decision. If there's one thing that connects all these lessons, it's this. Long-term investing has very little to do with finding that one perfect ETF or timing things perfectly. It's about building a simple system you can actually stick to through crashes, through boring years, through temptation, and giving it enough time to work. That's what my wife and I have been doing for 9 years. Not perfectly and not without mistakes, but consistently enough that our early retirement goal feels closer today than we ever imagined when we started. Now I'd love to know in the comments, what's the biggest lesson you've learned on your own investment journey so far? You can find my favorite low-cost brokers for ETFs in Europe linked down below, which is a great way to support me if you'd like to. Apart from gently tapping the like button and subscribing of course if you haven't yet. As always, nothing I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching, have a wonderful day and until next time.